Prices, charges, changes in a price is one of those things, okay, one of those most negotiated terms in any business deal that has a price associated with it. So in a contract, well, it is. And, well, there's a good reason for that, which is the reason why, by the time we are done with these, okay, you should be in a position to understand factors in supplier's pricing decision, understand supplier's pricing strategy, know the factors affecting the buyer's decision on price. And before we get started, okay, I just want to quickly mention that if you like getting summarized notes, summarized, downloads, practice exercises, videos, and all those things, make sure you join my newsletter, okay? Every week, we do put out all those contents. For example, every Monday, the Money Monday, we talk about aspects relating to like increasing your income, business tips, and things of that nature. Every Wednesday, you get summarized notes and things of that nature. So link is provided. Make sure you sign up. Now let's talk about factors in supplier's pricing decision. And when you look at any price, okay, the price of any product, there are a lot of factors that contributed to coming up with that particular number. I mean, if you just ignore the number and ask yourself, how did they arrive at this particular number? The decisions behind that particular number. So there are several factors that were taken into account. And for the most part, these factors can be classified broadly into two categories. And so we are going to have the external factors and the internal factors. External factors include things like price charged by competitors, the nature and extent of competition in the market, customer perception of value, which is the reason why you go to a restaurant, you pay a lot of money for something that you could have otherwise just eaten cheaply in your house. So what exactly are you paying for? Is it the food? Is it the perception? Is it the ambience? Is it the class? All that, okay? That's whatever you're willing to pay for, your perspective as far as that is concerned. Price elasticity of demand, that is the extent to which market demand rises or falls with changes in price. Okay, think of it this way. If you're selling something like, if you're selling juice, okay, refreshment. Now, if you lower the price, many people are going to buy that thing. What about if you're selling medicine? Do you really think price affects the demand? Like many people will buy because suddenly the price of, like heart medication or whatever it is low. So that's the thing with elasticity. There are things which reducing price won't even affect their demand, okay? They are inelastic. And then there are things which reducing price will definitely affect the quantity demanded. That's a factor. Also, we have what a particular customer is prepared to pay, environmental factors affecting the cost of raw materials, as well as environmental factors affecting demand and affordability. Those are external factors. But then you have internal factors, which will also contribute towards that pricing decision. And in this case, we have things like cost of production, how badly the supplier needs the business at a particular time, how attractive a particular customer is to the supplier, shareholders' expectation and managerial objectives in regard to profit margins, as well as the strategic objective of the organization. If you're negotiating with a seller or supplier, then by understanding the external and internal factors, then you quickly realize that there are some that are going to help you negotiate your favorable price, and there are those that will not make it easy for you. For example, if something is inelastic in terms of price, then you need to factor something else, okay? So the number itself won't change because the demand is not really necessarily, the up and down of the price is not necessarily going to affect the quantity demanded. So that's the thing. But, as at now, you understand that we have external factors and we have internal factors. Let's talk about the supplier's pricing strategy. Here's the thing. When you're negotiating with a supplier, or a seller, most people just assume that when the supplier says the price is 100, then I'm just going to say 60. And then maybe we'll get somewhere in between there. But there are a number of factors that, again, will go into affecting the degree to which a supplier can move, whether can reduce the price or not. And most of these will just depend on how they arrived at that price. In short, the strategy used to determine that particular number that now you want to negotiate over. There is a point, okay? There is a point to which those prices cannot go below. And suppliers' pricing strategies are likely to be based on either cost factors or market factors. And let's start by looking at the cost factors, okay? As in how do they arrive at that number? So that's the thing. And to start us off, we're going to look at the full cost pricing. In this case, the supplier calculates the total cost of a product, adds a markup to produce profit, and the resulting figure is the selling price. To avoid this one sounding all theoretical, let's look at it from a practical angle. And in this case, I want you to assume that we are dealing with a small business that makes custom-made, chairs. So the first thing when it comes to figuring out how we are going to price these chairs is to find our total cost. And there are two things that are used to determine the total cost. So in this case, we're talking about fixed cost and variable cost. So total cost is fixed cost and variable cost. What is any of those? Okay. So fixed cost, this is the price, or this is the cost that doesn't change with the level of production. The more you produce, nothing. You still pay the same fixed cost. Something like rent. You produce 100 chairs, as long as you're in that particular room, you are going to pay the same amount of rent. Okay. I mean, if they increase the rent, it's just going to be a stepping cost, because it will just be this way and then it goes up and then it remains there, right? So that is fixed cost. It doesn't change with the level of production. And then you have variable cost, which will change with the level of production. The more you produce, the more you incur. So anyway, in this example, our fixed cost, let's assume our fixed costs are workshops rent. So in that case, we have $1,000 per month. Workers' salary, $2,000 per month. Equipment maintenance, $500 per month, which makes our total fixed cost to be $3,500 per month. Now, our variable cost, the ones that are going to change with the level of production. In this case, so variable cost, we have wood for each chair, $50. Paint and materials per chair, $20. Labor cost, $30. So our total variable per chair is $100. Now, that is to make one chair. But then the question is, how many chairs are we making? Because we need to find our total variable cost. So this is total variable cost per chair. But then what about for all those chairs? So in this case, let's assume that you're making 100 chairs. Okay. Yeah. So in that case, the assumption, we are producing 100 chairs per month. Now, with that in mind, we need to determine again the total cost, and then we need to figure out our margin, add that to the total cost, and then break it down by the number of, or rather divide it by the number of chairs we are producing, and then we get our price per chair. Right. So the total fixed cost plus total variable cost in this case is going to be 3,500. Okay. That is the total fixed cost. And the variable cost, obviously 100 chairs times 100, which gives us 10,000, and making the total cost per month to be 3,500 plus 10,000, and that is 13,500. And so if that is the total cost, then we need to know total cost per chair, in which case we are going to take 13,500 divided by 100, and so we have 135. That is our total that is our cost per chair. Okay, each chair, it will cost us 135. Remember, total fixed cost plus total variable cost divided by the number of chairs we are making. So now let's assume that in this case our margin is 20%. Meaning what? For every chair we make, 20% of the cost incurred of making that chair, that should be our profit. That's the margin you're adding there. So we're not just going to take 20% and then add. You have to find what is 20% of 135, and then that number, we add it back to 135, and that becomes our selling price. Meaning what? Meaning, so if it is 20%, so we'll take 20 of 135, which will give us 27. So 27 in this case, that is what is going to be our margin. And then now we add that. So the full cost per chair, we take the 135, which is how much it's costing us to make a chair, and then we add our profit margin. Remember, 20% of 135, that is how much you're supposed to be making. We are saying that for every, again, repetition, for every chair we make, we want to make 20. Okay, that's our profit margin. So if you are making, it's like saying for each of this pen, if it costs X to make pen, then 20% should come out of every pen. So in this case, we will take 135, 20% of that is 27. So we add, okay, 135 plus 27, and our price is 162. So that is the full cost, okay, pricing. Fixed cost plus variable cost plus margin. So you find the total fixed cost, find the total variable cost, divide by the units you're producing, get the margin of that, okay, the margin that you had come up with, which in this case was 20%, add that one to that one, and then now you have your selling price, full cost, okay? If you have any question, obviously, ask. Let's talk about cost plus or markup pricing. In this case, the cost plus or the markup pricing, the supplier calculates direct cost of a product and then adds a markup sufficient to cover overheads and produce a profit. So how does this work? Look, here's the thing. If you're making something, if you're making a pen, so then the question becomes, what are the direct costs associated with producing this particular pen? All the costs directly associated with the production of the pen, which means the salary of the CEO is not directly attributed to the production of this pen. That becomes the overhead. So you first of all get all the direct cost. Once you've gotten the direct cost, and then there is a margin, okay, that you had created. This margin is supposed to be sufficient enough to cover all the other costs that we've ignored, the fixed cost and other things that are not directly associated with the production of this pen. So we add that one, and then we get our, our price. Okay. So if you're thinking, how does that differ from the full cost? Full cost, we are talking about fixed cost plus variable cost. With the cost plus method, we're talking about direct cost plus the margin or the markup. An example here, let's assume we are dealing with the bakery, and in this case, the ingredients, the direct cost. In this case, the ingredients cost 20 per cake. Okay, the labor cost 15 per cake, packaging cost 5 per cake, which makes our total cost to be 40. So now we have our total cost of making a cake, which is direct cost. All right. So notice we talked about labor, we talked about ingredients, all that stuff. Those are direct costs associated with manufacturing that particular cake. Well, manufacturing, whatever, making that particular cake. So now we need to add a margin that is sufficient enough to cover for all the other costs that we've ignored, that we're still going to incur, like salaries of the security guard and, all that stuff, right? In this case, let's assume that the bakery wants to add a 50% markup to cover overhead expenses like electricity, rent, equipment, and generate a profit. So the first thing we need to ask ourselves is 50%. How much does that translate to in terms of dollars? So it's 50% of the cost you're dealing with. In this case, what was our total cost, or our direct cost was $40. So it's 50% of 40, and that makes it 20. So now we take, remember, cost plus the markup. So 40 plus 20, and that will give us 60. And 60 becomes our selling price. So again, to summarize it up, when you're talking about something like the cost plus, okay, then we first of all figure out the direct cost associated with making that thing, and then we had the margin that is supposed to generate profit plus overheads and all that stuff, and then we get our price. As always, if you have a question, again, let me know. Let's talk about the marginal pricing. Now, marginal pricing is actually an interesting thing, because with margin, you're just talking about the next one. Okay, think of it this way. Let's say you're making, let's say this is a thing. You're dealing with pens, right? So there is this pen. What is the cost of making this pen? You know that one, right? But then what if we add an extra one? So how much will it cost us more to make the next one? Okay. Will it cost us more to make the next one? So the next one here is margin. Okay. So this, when you talk about marginal pricing, it's just how much does it cost us to make the next thing. So if there are 4, it means what's the margin? Well, at this point, there are 4. If you add a 5th one, that's the marginal, right? So marginal is always going to be the next thing. So in this case, the company or the business is simply trying to figure out, yes, we are making these things at this particular price. If we add more, is it going to cost us less, or is it going to cost us more? I mean, there are scenarios where making an extra thing doesn't cost you much. There are scenarios where making an extra thing will cost you much. So let's take an example to understand that. Okay, so first of all, for example, if I produce a PDF for you to download, the cost of doing that is high at the start, but then the cost doesn't increase with the number of downloads. Okay, so as you download my PDF summaries and all that, it doesn't really cost me more now, does it? But it was expensive when I was starting, right? If I'm doing it, just doing one, research, writing, editing, all that stuff, right? Speaking of PDFs, downloads, and content and things of that nature, if you're interested in getting those sort of things, make sure you sign up to my newsletter. Okay, every week you'll get at least 2 newsletters depending on the choices that you've taken. There's going to be one on Monday, which just talks about, revenue, business, increasing your income and things of that nature, business tips, all that stuff, right? The Money Monday. And then Wednesday, again, depending on the choice you've taken, okay, you'll get summarized content depending on if you're doing these and you're in CIPS, okay, you're doing procurement and supply, depending on the level you are in. For example, if you're in level 4, you get issues relating to level 4, 3 issues relating to 3, 2 issues relating to 2, 5, 6, and all that, right? If you're not even doing all those ones, of course, you'll also get content that's just associated with, business from a general perspective. So there is that. Make sure you sign up. Now, let's continue with the marginal pricing. Remember, what's the cost of making? The next thing, the marginal, the next thing, okay? High margins, on the other hand, so remember you can have less margins, like the PDF examples. But then high margins, on the other hand, include things like cost of manufacturing an extra sport car or a bespoke suit. See, that doesn't cost you less. You go to a tailor, you say, I want you to make this particular custom-made suit because of your whatever status in life and things of that nature. It doesn't cost that tailor less to make an extra one. It will just cost them more because these are designer stuff, which is different from if they're just doing mass production. So with mass production, cost less. With custom production, the extra one still costs more. Now, let's see. To understand that, let's look at it from a practical angle. And let's assume that you are, again, dealing with a bakery and you make 100 loaves per day. Obviously, if you're making 100 loaves per day, you're incurring both fixed and variable cost. And so if you make an extra loaf, 101, the fixed cost doesn't really change now, does it? So let's assume that when you're making these 100 loaves, you've already covered your fixed and your variable cost. Well, in this case, you've covered your fixed cost, which means when you're making the next one, you're just going to assume that the only new number that you're going to be dealing with is the variable cost because the fixed costs are already there, already covered by the first 100. Are we on the same page here? Okay. So if you're paying rent to make 100 loaves and there is still space in that room, by making 101, the rent doesn't go up. That is all you're saying. So in this case, let's assume that our fixed cost, okay, so the rent is 1,000 per month, salary is 2,000 per month, equipment 300, which makes our total fixed cost to be 3,300. But then our variable cost, okay, in this case, one loaf, so ingredients, $1 per loaf, packaging 0.2 per loaf, labor cost 0.5 per loaf, which makes our total variable cost to be $1.7 per loaf. We already know that the fixed cost doesn't change. We are assuming that at 100, you're already covering your cost. So with that extra space, let's say you decide to make 20 extra loaves. So the question is, these 20 extra loaves, how much will they cost you? I'm just feeling hungry talking about bread. Anyway, so those 20 extra, how much will they cost you? That is what you're trying to figure out here. Assuming that, we are holding the assumption that the fixed costs are already covered. So which means the only extra money you're going to be incurring here or extra cost is going to be variable cost. Since our variable cost is 1.7, okay, let's assume that the bakery decide to set the price of the extra loaves at 2.50. At this point, the price covers the marginal cost, which is 1.7, and leaves 0.8 per loaf as additional profit. That's the thing. So the first loaves, we are selling them at a totally different price. In fact, the first loaves, you're selling them at $4. Let's assume that's a thing, okay? Because the question will be, okay, how much are we selling them for? So the first 100, those ones go for $4. But then the next extra ones, the next 20, the marginal, the 20 extra that we are just making based on the extra space we have, those ones go for 2.5. So how does this affect the business? So our current sale will be 100, the first ones, times 4, which means we're making 400. Then the extra, which is 20, multiply that by 2.50 will give us 500, which means our daily revenue is 450, which means the bakery will increase its total revenue by 50 while only incurring additional variable cost of $34. That is 20 times 1.70. That's the assumption. The assumption is, well, since you're already incurring fixed costs, this extra one you're just going to incur variable cost. And so that will give the business an extra $16, that is 0.8 times 20. Remember our difference, okay, between the price you're selling and the variable cost was 0.8. So that becomes our profit per day. Now, this can't always just work every time. The only time this one will work is if, number one, there is an extra production capacity. It will only work on a short-term basis, okay? Otherwise, you have inventory problems to deal with. It will also work if competition is such that lower prices can help you remain competitive without losing money. Because if it is something that doesn't get affected by change in price, then it also won't work. Marginal, all right? Meaning what? How much does it cost us to make the extra thing, assuming this other thing is already working? So there is that. Let's talk about the rate of return or target pricing. Now, with the rate of return or target pricing, the supplier bases the profit on desired return on investment. Look, think of it this way. If somebody says, if you have a business idea and someone says, here's $100, 100,000, whatever it is, $100,000, I need 20% return on that. And again, let's say in that business you're selling a pen. So then the question becomes, how many of these pens are you supposed to sell so that you can generate enough to give that person 20% on their 100,000 that they gave you? Assuming that you're also going to make something out of that. So the price is supposed to be such that it can cover that amount that you're supposed to make, and then the extra return that is needed. These strategies, the strategy involves figuring out a price that will cover all costs, that is fixed cost plus variable cost, and still get you the return you desire. But then the question becomes, since this is learning by doing, how does that work practically? And in order to understand that, let's make an assumption, okay? Let's imagine a company that creates custom-made furniture and it desires a 20% return on its investment. Now, the first thing we need to understand is what exactly is the cost of capital employed? How much are they putting in? Because that becomes the investment. And from that, we need to get 20% of, whatever. In this case, we have furniture making equipment, which is $100,000. Inventory, like wood, tools, supplies, $20,000. Factory building, that is $80,000. So the total capital invested in this case is $200,000. Now, we know how much we've invested, but what cost are we incurring to do that thing, to make those things? So let's figure that one out. So it's like I gave you $100,000. Now you just can't say, yeah, I'll give you 20% back. You need to understand from this 100,000, okay, how much am I in, what is the cost of doing whatever I'm doing, first of all. So the total cost, or the cost in this case, we're talking about fixed cost per year. So that will be rent, equipment, maintenance, insurance, that is 50,000 per year. Salaries for employees, again, 100,000 per year. So that is their total fixed cost, which is 150,000. Then you have variable cost per furniture. So wood, $100 per item, labor, 50, other materials, 30 per item. So the total variable cost is 180. But then that is per whatever it is that they're producing. Then there is a question of how many of these things are they producing so that they can find the total variable cost for everything. So in this case, the company produces and sells 2,000 pieces of custom furniture per year. And that will make our total variable cost to be 180. Remember, that was per item, times the 2,000. So that gives us 360,000, which means if we add that to our total fixed cost, which was 150,000 per year, then our total cost for the year is $510,000. Remember, the company desires a 20% rate of return on $2,000 capital invested. $200,000 of the capital invested. So we take that 200,000, multiply that by 20%, and we get 40. So that is what they want, $40,000. So at this point, it's important for you to understand something. And about something like revenue, simply talking about how, when you're in business, profit is not the same as revenue. So these people desire $40,000. That is not revenue. That is what they want. Okay, that's an equivalent of their profit. Like if you're selling this pen for 10 and you sell 40 of them. So now it's 40 times 10. That becomes, the 400 becomes your revenue. But then you still have to figure out things like cost of goods sold, direct expenses, blah, 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 all the way to your profit. So when somebody says, I want 20% on whatever it is that I've given you, that 20%, they want that 20%. After you've taken care of all your costs, I just want my 20%. Okay? So anyway, so in this case, we figure out that the 20% is going to be $40,000. So let's see, what is our selling price? Because we need to understand our selling price, because revenue will be the selling price times the number of units that we sell. So to understand that, so you know the required revenue is equals to total cost, okay? Total cost of making that thing plus the desired return. That's the revenue, right? So in this case, $510,000 plus 40, we have $550,000. So if we get that, if we get the $550,000, then that is enough money to guarantee us our 20% return. But then from this $550,000, how much are we going to sell for? So it's just a question of taking that thing, dividing by the number of units you're going to sell, and that number becomes your price. Meaning what? Meaning we take our 550,000, okay, divided by 20,000, which are the units you're going to sell, and that will give us a number. It means you have to sell 275 per item, and then we get the money we want. We also get, so we get the revenue we want, which means we also get the desired outcome. And so if that is confused, just think of it this way. If somebody says, I'm giving you this money and I want 20% return, then there's just the question of what is 20% of that amount of money they've given you. Then that becomes the money that they want. So then you figure out what is the cost of doing this thing that you're doing. Okay? Fixed cost plus variable cost. Once you know the cost of producing whatever you're producing, then you add that number, the desired outcome. You know, they gave you 100,000 and they want 20%. So you get 20%, you add that onto the cost of producing whatever it is that you're producing. And then you take that number, divide it by the units that you're going to sell, and then that becomes your selling price. So in this case, when you sell that times the number of units you're going to sell, it means you'll have your total cost of producing that thing plus the desired outcome, the 20% that they wanted. And so you'll be able to give them back the 20%. You'll also be able to cover your costs of production. So that's the thing with the target or the rate of return, pricing. So the factors that will affect a buyer's decision as far as price is concerned, okay, will include things like the buyer's relative bargaining power. For example, if you're in a market where there are more suppliers than there are buyers, then in this case, who's powerful? Obviously, the buyer is powerful. It's because they have options. And if it is a market where, like a monopoly sort of situation, where there are few suppliers, many buyers, and the suppliers are powerful. So it's just a question of who has the upper hand in this scenario. If the buyer has an upper hand, then they're going to use that to negotiate. The same goes for the possibility of substitute product in the market, the type of purchase, okay? Are they buying something critical, or is it just a routine purchase where they don't have to put a lot of effort into it? Or the price the competitors are charging, that can also affect the buyer's decision. Or actually the price the buyer can afford, because sometimes you can have all these things where it's like, yeah, we have the best price. Well, that's the best price according to you. What about the buyer? What's their perspective on the price? So those are things that can also affect how the buyer makes a decision to buy. So the point here was for you to understand that, yes, when it comes to suppliers and their pricing, there are things you need to know, okay? You need to know things like factors in supplier's pricing decision. You need to understand the supplier pricing strategy, and you also need to know the factors affecting the buyer's decision on price. As always, if there is any question, you ask.